And we start in the US, where it has been downgraded by the Fitch agency, the ratings agency. It's lowered its top rating in an unexpected blow to the world's biggest economy. So Fitch cut the US debt rating from AAA to AA+, citing America's erosion of governance and rising deficits. And the move comes 2 months after a last-minute deal that was reached to lift the debt ceiling and avert the country's first ever default. US Treasury Secretary Janet Yellen called the downgrade arbitrary and said economic conditions had improved under the Biden administration. The news of this downgrade came after the close of trade on Wall Street in the US. But in Asia, investors have been reacting and pulling out of equities. If we have a look at financial markets in Asia, the day is pretty much at an end. In Japan, down 2.3%. A very similar story in Hong Kong. Mainland China markets lower, also in Australia and across the region. Well, I talked to Tom Stevenson, who's an investment director at Fidelity. He said he's not surprised the Biden administration is annoyed with this credit rating downgrade.
It seems that the data which Fitch have used to make this analysis covers the period from 2018 to 2020. So it's easy to see why the US Treasury and indeed the White House are pretty furious about what's happened. But I think a bit of context is important. This is not the first time that the US government's rating has been downgraded. Standard & Poor's, which is one of the three big ratings agencies, actually downgraded the debt in exactly the same way from AAA to AA+ in 2011 during the sort of Eurozone debt crisis that we had back then 12 years ago. That really didn't have a huge impact on US investments. As we know, US investments have been very strong over that period. So I think a bit of context is important here. It's not good news for the US, and it's you can see why the authorities there are not pleased with this downgrade. But I think the impact might be relatively limited in the long run.
In terms of their concern about governance, saying that it's not improved, it's actually gone the wrong direction over quite a long period of time. That's quite damning, isn't it, really?
Yes, and to be honest, that's fair comment. I mean, every couple of years we seem to get one of these situations where there's wrangling, bipartisan wrangling over the debt ceiling. Really, the debt level in the US is used as a political football to kick around, and the House of Representatives stands off against the White House. And we saw that a couple of months ago. That debt ceiling crisis was resolved a couple of months ago, and that, I think, makes the timing of this downgrade slightly curious, because it's hard to see that the information that Fitch has now is any worse than it was 2 months ago when that crisis was resolved.
When we look at what it's saying about the outlook for the US economy, what I saw, which is quite interesting, it's saying over the next decade, higher interest rates and rising debt will increase interest service burden. So we understand that, but it's also looking at the ageing population and the costs that will ensue. Rising healthcare costs will raise spending even more. They've got to spend more on the Medicare, the Social Security. It's quite an in-depth look at what's ahead for America, which is true for many economies, isn't it?
Yeah, absolutely. I was going to say that is not an America-specific problem. You know, a lot of money needs to be spent. Aging populations, there's a lot of cost involved in healthcare, just general infrastructure spending. And that's particularly the case in the US. Actually, the US infrastructure is aging, crumbling in many cases, and needs a lot of money spending on it. So, yes, the fiscal outlook is challenging for many developed economies, but particularly so for the US.
Just really briefly, Tom, I'm going to be told off, we're out of time, but just in a sentence, what do you think Wall Street will do when it starts to trade later today in response to this?
Okay, well, very briefly, I think that the evidence from Asia is that the equity markets will probably suffer a bit. I think the bond market actually could probably go the other way, because there will be an element of a flight to safety. We often get this when there's stress in the system, there's a flight to safety and people actually want to buy US government bonds.